Today we're going to talk about these three facts of trading. If you learn how to do this, then when you see the market instantly, you will know what's going on there. So I will draw a graph for you, because since we are going to learn about the trend here, So how we know trend is, it's very simple. We all know that there is this graph is just going up. This is uptrend. There are three different types of trends, which is one up, one down, and another one is sideways. So going up, going down, or going to a sideways. And these are classified like this because of these highs and lows. Highs and lows are here. It started from here, let's say, goes up, right? This is called high, and goes down. This is a low. And what about this? Again low, because going up, down, this is high and high. But what is important here, even if this is low, the same lows, when you see this, it's going up, right? The lows are up, it's going up higher. And highs as well, it's making new highs. So this is called higher highs, making higher highs. And here in lows, higher lows and higher lows. So basically, this is the thing that you see, that to see if the trend is up, down, or sideways. So you might ask, what about these kind of graphs? And it goes up. Or it can be like until here. Let's say this is the current situation. And what about this? Here, this is higher low, but this one is a low, but lower low. It's called lower low. And then this one is also lower high, because we compare with this high to lower high. So even if this happened, it doesn't mean that the market structure has changed. It just means that this is just, for example, faking, or this can be our entry model. That's called swings. So if there are swings, okay, I will zoom in this graph for you. We don't know where it's gonna go, but since we know there's lows, and highs, I didn't make it specifically like this. Since this try to make lower low, and then try to change the direction. But when you see in the real graph with the candlesticks like this, you will be able to find something called a fair value gap. These fair value gaps are called FVG, and they happen because of the market imbalances. So when the imbalance happened, so for example, yesterday the Coke price was $1, but today it became $10. There's an imbalance of $9, right, in between. And then this market price, people will, because you know that you're not going to buy, and I know that I'm not going to buy the Coke that is $10 worth. I know what the Coke was before. So I wait until the price goes down, even if I know that I want Coke so badly. I will wait until Coke to fall down the price, and then I will start to buy there. It's the same. So when the market imbalance happen around here, it'll fall down eventually. But there's a little bit of difference here. We are using fair value gap, but we are changing this to inverse fair value gap. What it means is fair value gap. When there's fair value gap, you can touch it here, and then you can go up. You can do this, just like the other lower lows, higher lows, and higher highs, just like that. But we are going to look for inverse fair value gap, because for me, just the fair value gap is a little bit weak. Inverse fair value gap gives one more additional reason to have your own position. So once it reverses this fair value gap and tests, then this is the place where we go for, at this point, it's a short, right? This is the place where we go for short, and our stop loss will be on top, previous high, and then target at least 1-to-1, or you can target, for example, these are our liquidities. Liquidities are the ones that where people's stop losses or the liquidation levels are. Liquidation, like, literally means that money is very liquid. You can buy this coffee, you can buy a bag, you can buy a phone. Money can be anything, just like water. If you put it in any kind of a plastic bottle, water can change its shape. So that's why money is called liquid. And this hard money, if you buy the position, for example, you bought a position long here, then your liquidation level, like let's say it's here, is that this whole hard position, your like physical position, going into water, like liquid position again. That's why it's called liquidation. And then once it takes one, there's very high chance to take another one that's right behind it. It's not much different here, so there is a high chance to take it. So once it bounces back, we enter, setting our stop loss here and target down here, at least 1-to-1. And then if you see any easy liquidities, here, any easy ones, or you can use fractals and go into higher time frame. So I will finish this one first. Higher time frame, let's say this is 1 minute Nasdaq NQ or US 100. They're the same thing. It's 1 minute, okay? If you go into 15 minutes, then you will see this whole leg movement will be just like one candle. So in 15 minutes, it's gonna show like this, but this whole movement in 1 minute will be only here. So when you short from here, your stop loss is up there, which is here, and target will be the back-to-back liquidities. So very easy, it's gonna go 1-to-3 risk ratio. So forgot about it. So 1 minute has to be entry, and 15 minutes, 5 minutes, or 1 hour, it has to be liquid targets, where you have to put your targets, because that has less noise. Higher time frame has less noise. Compared to 15 minutes, 5 minutes is a lower time frame. But compared to 1 minute where we enter, 5 minutes is a higher time frame. 15, 1 hour. So swings, going back to swings. Goes up, down, and then up, swing. So swing means going up, going up, going up, going up, swing higher to make new highs. And this, when it crosses new high, and it creates, when it's going higher, it creates fair value gap, as we talked about. It try to swing high to go up. But this price, as you can see, it fell down, right? So once the same inverse fair value gap, we are focusing on inverse fair value gap. So it'll come back and retest, all right? From this retest, your stop loss will be up here, the same. This is 1 minute time frame in Nasdaq or NQ or US 100. It's the same thing. And target your liquidities like this. It's the same. It's exactly the same what I just explained about fair value gap. So this is swings, and this was going for short. But what about long, right? We are using the trend, highs and lows, and use swings. This is the steps. These are the steps. Again, now we are gonna look for longs. So we go down like this, right? It tried to swing high, but it fell like this. Let's say that there is a fair value gap here, like this. And then it swing lower to make even new lower. But what is this? It didn't create, what is this? Swing low, right? And then there was a fair value gap created here. So this, when the price is going down, and there's a fair value gap. If fair value gap reverses, this becomes inverse fair value gap. And once this rejects means that if this bounces back, this is our position, our long position target. And our stop loss and target will be this one, or in higher time frame, let's say this is 1 minute, then go into higher time frame, let's say 15 minutes. This in 1 minute target is, let's say, here, but in 15 minutes can be up here. So risk ratio is all sorted out. I think you might ask about how does fair value gap look like. The fair value gap appears like this, always appears like this. And let's say that it's going up. Let's say it's going up. Then we make candles, like the candles show like this. So we disregard the second one. We always get from this first one and the third one. First and the third. Always. Not the second one. Because this is the market imbalance. So we make a line. Do you see this one? The tip of the first candle. And then the lowest tip of the third candle from here. I will extend it. And this becomes fair value gap. This market imbalance comes in, bounces back, or reverses, bounce back. These are two fair value gap types, and we are only looking for this one. Reverses or inverses, and keep on coming down. If you use this, you'll be able to spot in very early phase of in trend reversals. So as I taught you here, 1, 2, 3, trend, highs and lows and swings. Use these. Keep on practicing these ones, only these ones, and I can promise you that this will shape the whole market structure vision towards the graph. Thank you so much for listening, and subscribe to our channel. I will share more tips to read the graph and pass the prop firms even. I also did prop firms before. And then this will be very effective for you, since you might not know what to do, you might not know which strategy to use. I will share everything that I do. We also have a PnL app. It's a trading psychology app that makes you and shapes your whole trading behavioral patterns. It makes your habit for you, so you don't lose anymore with emotional trades. So download for that. I will put it in a link. See you next time.